most instruments, whenever I hear about them, I look at the price chart. It's stretched from the moving average, stretched from the moving average. By the time CNBC talks about something, it doesn't mean it's a top, but most often than not, the price is very stretched from the moving average. So it's like, oh man, it's done. That move's done. It doesn't mean the bull market's over, but it means it might need a pause or something. And this is the trap. People buy on that, and then it's still in the bull run, whatever, let's say NVIDIA or something, but then they buy because they stretch from the moving average, and then the price corrects 10, 20%, or corrects sideways for a year or two. People give up, and then it goes back up.
Hello and welcome to Capital Cosm, everybody. Today we have another returning guest that I've been excited to have, especially because of the recent move up in the uranium price, Mr. Patrick from North Star Bad Charts. Patrick, thank you for coming on, my friend.
Hello, sir. It's always a good moment there to catch up with you. So hopefully we get to cover some good value there for all your viewers.
Yeah, I mean, little does the audience know, we've already been talking for about half an hour now. So many, I just wish I hit record at the very beginning, but we'll there's still a lot of stuff that we can talk about. Before we get started, though, nothing in this video is financial advice. Neither Patrick, Kareem, nor I are financial advisors, so please do your own due diligence. With that said, Patrick, for my audience who may be coming across you for the first time, give us a little introduction in terms of who you are.
Well, look, I've been chart trading for 10 years, 15 years already, I think, 2007. I started trading back in 2005 or 6. Everybody started working, and then you accumulate some capital and said, okay, what do I do with that? But at the beginning, I fell into all the traps, Googled how to invest. But you know what pops up first? It's like the tourist traps when you land in Paris there, and Champs-Élysées, the first restaurants aren't the best ones. I fell on all these penny stock forums. I bet a whole bunch of money, didn't understand risk money management on the wrong stocks. But during the night, I had my heart was racing because my body was saying, Patrick, something's wrong. You put everything on this stock because this guy on the internet said this thing is going to the moon. It's a new crazy product, whatever. So I cleared that out. And then I was recommended a book from Stan Weinstein, Secrets for Profiting in Bull and Bear Markets. And then it's just, everything made sense. He explains it in that book that fundamentals, they don't often match the price, right? He says in the 1980s or 70s, Stan played the casinos. The fundamentals of casinos were terrible. But you look at the charts and saw it's a nice, beautiful basing pattern. They were starting to break out. It says, man, money's going in here, overwhelming the money leaving that sector. And he started playing that. And he only saw that because of the charts. Because in the news, they never talk about stuff that the price goes sideways or down. It's boring, right? People, if you hear about in the news, it's mostly because the price went up tenfold and cool, this guy made money, but you should take a step back and you should say, that's past performance. Right now you have to look, where am I in that cycle? So charts, they make just so much sense for me, and I've just been doing that, deep dive that since then. Reduce the noise, guys. Remove all those headline narratives. We could talk about them. They're great for we could go down some rabbit holes. I don't mind. But for my investments, for my money, always use sound risk and money management. Always use objective chart analysis, weight of evidence, and forget all the noise, guys, because you'll see there, the best opportunities is when nobody's talking about something or very little people. And only charts will be able to present to you that, well, maybe not only charts are, I'm sorry, some guys are very knowledgeable in their field and they'll be able to spot, something that's happening, but the charts will give you the timing when the actual money is going to that field. Because if the money's not going to that field, even if you have the greatest idea since a sliced bread, it's like, who cares,
Yeah, the charts paints the story. It paints the story of human psychology over time, right? Because humans interact the same way with one another. We retain these tendencies. I mean, we're still the same people that we were hundreds, if not thousands of years ago. So,
and I'll tell you the beauty of that. This is the beauty of a chart, guys. This is how powerful they are. You could listen to one guy with a fundamental story says this XXX has to go up because of blah, blah, blah. That's one person. But yeah, take a step back. The planet's huge. There's billions of people. There's hundreds of thousands of people with varying amounts of investable capital, and they each have their narrative, their story. But this is what charts do. All these people eventually at different times, sometimes it's a hedge fund, they could only buy at the end of the quarter. Sometimes it's, or some other pension fund, they can only rebalance. All these people buy different moments, different varying amounts based on all those various fundamental analysis. But you'll see the aggregate of all these people. You'll see that in the price chart. All you have to do is study one chart. That's all you have to do. Am I in uptrend? Am I above the inclining 12-month moving average? Am I above resistance? Have I been basing for 10 years? Is the rate of change, the momentum, is it expanding or decreasing? I don't care for all the reasons, because everybody who had a reason plays their bets, and that's the outcome. That's the beauty of it. It's so simple in its nature. And I know, of course, you could ask me, well, Patrick, if it's so simple, I get the trolls recently, man. Oh, if it's so simple, how come you're not a billionaire? Well, just because you ask that question is because you don't understand risk and money management. But somebody who's on the other end, somebody who manages a hedge fund, a pension fund, a Warren Buffett, they understand risk and money management. Professional players in basketball, Michael Jordan, Floyd Mayweather in boxing, or Phil Ivey in poker, they all understand risk and money management. You think, like I was telling you before we start recording, like Michael Jordan, he doesn't shoot 3-pointers all the time. He can nail them, but he knows those are lower on the probability spectrum.
Right.
The dunk is the highest probability move. So if he could do a dunk, he's going to do a dunk, even if it's not 3 points. He's not going for the Hail Mary. He's going to try to do that, right? Baseball players, if they're able to hit singles and move the around the bases, they're going to go for that instead of going for the lower probability home run shot, right? Because remember, those home run hitters, they also strike out a lot. Floyd Mayweather is going to go with the jab, the high probability. I'll tag you. You won't be able to tag me. You'll keep your distance with the jab. It's the safest punch in all of boxing is the jab. Don't go for a right cross and leave yourself open. So all these professionals have long-lasting careers. They all understand probabilities. They all understand risk and money management, or risk management. They all do that. And the reason we appreciate Michael Jordan as a great today, it's not because he took crazy risks in the early in his career. It's because for decades, he repeated the high probability plays over and over and over. And over time, he built his track record, right? Just like a hedge fund manager, he's going to do what? It's 20, 30% per year. That's not going to bring you to $1 billion. And that's going to tie me to your point. Guys, we all have different starting NAVs. We all have different lifestyles. Some people like to live extravagantly, some less, some have more taxes, some less. So let's say a professional trader, guys, it's about 30% per year. A very good one is going to do 30% per year. Even a fund manager, right? I don't know what Warren Buffett or Peter Lynch, all these guys, 20, 25%. Think about it. $10,000. Let's say their starting NAV was $10,000. Do 30% of that compounded over 10 years, you had $137,000. You're not a millionaire. So at 30% per year, and I'm not removing taxes, I'm not removing you taking some of that capital out to feed your family, right? I'm doing like compounded.
Yeah.
So that 10,000, you could do tenfold in 10 years, 10 years. And then maybe that 137, you can make it to 1.5 million in another 10 years. So you're at 20 years. And then after that, you look back. So let's say you understand this concept early at 25 years old. You look back at 45, then you'll have millions, possibly if you put in the hard work and you were consistent in your results and you didn't go for Hail Marys, then you'll have $1 million to give to your kids for you to live off. But what's happening now on Twitter and everywhere, everybody's selling the dream. That's what happened. Why do you think everybody had Bitcoin accounts with hundreds of thousands of followers, the YouTube channels, Bitcoin, the laser eyes? It's because the price went up and they were driving their Lambos. I don't know where they got their Lambos, but maybe these guys, they bet all they had. And yes, the Bitcoin did move up, or any stock, any penny stock, right? Could have been cannabis stocks buying weed at 5 pennies, which went down to 50 and now back to 5 pennies. Could have been any of those things. But those, with the stories you hear about, are the low probability plays, because all the hundreds or thousands of pension fund managers out there that have been in the game for 10, 20 years. They're not doing it 10,000% per year or 1,000% per year or even 100% per year. They're doing 20, 30%, but consistently year after year after year. So this is my rant for that. And this is, so it's not just for trading, chart trading. It's for fundamental traders, chart traders, professional players, any guy who's professional. You need time, and the higher, the bigger your starting NAV. So if I would have started with 100K or I start with 200K at 30% per year, I'll have my million in 10 years. I'll have more than $1 million in 10 years. But people have to consider that. So if somebody says, how come you're not a billionaire? It's because they, in their minds, they're already binary. I bet everything. That stock, people, that's how the way they sell it, right? They say, oh, Bitcoin, let's say, I don't want to pick on Bitcoin, guys. It could be anything. That stock went up 1,000%. And in their heads, you hear that. Oh, the guy says, oh, I have 100K in my bank account. If I would have put my 100K in that play, I'd do 100K times 1,000%, right? And then you do the math. Oh, I'm on the beach with my wife and life's great. But guys, you're assuming that it's 100% probability that you're gonna reach that target. Seriously, that's what you're, and that's assuming there's no drawdowns, and you don't panic, and you don't sell at the wrong moment. It's bonkers. You can't do that. You just can't.
Yeah, it's the best case scenario, and then you assume the best case scenario as your base case scenario. That's the fallacy there. It's also kind of harkens back to that question: would you rather have a penny that doubles every day for 30 days, or $100 million? A penny that doubles every day for 30 days. I mean, you're going to be, I can't remember what the exact number was, but it was like in the hundreds of billions, right?
Yes.
Billions. So the power of compounding is truly, it's something that is lost on people, especially in today's day and age, where the average holding time for a stock has gone down from, I think it was 6 years or 5 years in the 1950s. Today, it's like only a couple months.
Wow. Oh yeah. So we got those stats like from Robinhood and stuff, like the brokers gave out that information.
Yeah. I can actually go pull it up really quick if you want to keep talking.
Yes. Well, that makes total sense because look, the trades we have on our website, I'm on monthly candles to reduce whipsaws. We have like a directional tracker where we're able to go on the shorter term movements, but a strong, higher probability, meaningful move, 6 months, easy, a year. But people don't understand this. This is like, it's like a rolling mechanism. The that it takes time to create that wealth. The earlier you start, so let's say you do it, your trades do last a year, but you start a trade here, that first trade in 1 year, it's going to give you the results. But on the second day or the next month, you could open another trade. So as in the future, as those trades start closing, well, if you open them at, I don't know, monthly intervals on the way there, then they'll be closing at monthly intervals later on, not 1 year, right? So, but again, that's not how you get 1 million followers on Twitter. I'll tell you.
Nope.
That's you have to promise the moon, always find a reason, and that's how you get a lot of followers.
Yeah. So here back in the 1940s, you were looking at an average holding period of 12 years. And then even in the 1950s, you were looking at 8 years. And this doesn't go as far. This doesn't take into account today. I think today is even worse because this is saying about a year's worth of holding time. I would wager to say it's a lot lower today than a year's worth holding time, especially with the introduction of Robinhood and all these apps on your phone.
3.2 years. Yeah. Oh yeah. Well, so that goes line in line with the attention span of people, you know. It's like the tweets are short. You try to explain something in one tweet, it's practically impossible. That's why it's fun us like having conversation on YouTube or on the podcast. So at least we could nuance some stuff and give some insight. But ideally, we'd have to be doing the Joe Rogan style, sit a couple of hours and, you know, just like philosophize, talk about all the details, go through all these charts. Look at this one.
Yeah. So this is from 75 to 2022.
That's so interesting.
5 years to 10 months.
You know what I see? You show me a chart. I want to do some TA on it. My first reflex is, where's my trend line? Where's my moving average?
Yeah. Are we about to break out? Are we going to see a new high in holding period?
Well, I'll tell you one thing. Okay, let's talk about these type of charts. That was good, that chart. A lot of people you'll see, they'll put up a chart on Twitter, and they'll put an arrow somewhere like that guy did. It's going down. But that's not what TA is. Technical analysis is the study of, let's say, the momentum of that chart. Yes, it went down, but has the momentum slowed down? Has the momentum started creeping up? Because that's your edge as a chart trader. You don't want to buy the exact bottom because you'll never get it. You'll never get the exact bottom. You could, but it's a low, it's like I said there, it's a low probability. It's like shooting from the half court, you know? Oh, I got the, you know, bragging rights, but don't be a hero, guys. Seriously, the hero dies. You can't be a hero.
More often than not, yeah.
Ah, Jesus. It's like, seriously, if it wasn't for Hollywood there, a knight facing a dragon, seriously, the dragon kills the knight every single time.
Yeah. You're looking at an anomaly. Yeah. What about all the other people that tried to be heroes before the night?
Yeah, they got burnt, right? They're the pile of ashes, right? At the you're right. It's so right. It's all the skeletons are all there.
Yeah, the movie's just capturing the one guy who finally got the dragon.
And you got to do proper TA on any type of data. And if you're able to crystallize, look, if your viewer is somebody who doesn't like TA, but if I'd be able not to convince them, but show them that it gives you an edge, that you're able to spot slowing and momentum that's changing in the other way before the momentum stretches the price away too far away from moving averages. And I could show you how that was useful to catch the Bitcoin mania back in 2021. When it's too stretched, the price from moving average, that's the chart, like you said, study of human emotions. It's telling you that everybody's going to start looking at that instrument. Most instruments, whenever I hear about them, I look at the price chart. It's stretched from the moving average, stretched from the moving average. By the time CNBC talks about something, it doesn't mean it's a top, but most often than not, the price is very stretched from the moving average. So it's like, oh man, it's done. That move's done. It doesn't mean the bull market's over, but it means it might need a pause or something. And this is the trap. People buy on that, and then it's still in the bull run, whatever, let's say NVIDIA or something, but then they buy because it's stretched from the moving average, and then the price corrects 10, 20%, or corrects sideways for a year or two. People give up, and then it goes back up.
Yeah. I mean, because these media channels are in the business of making money. How do they make money? By eyeballs and getting eyeballs. And what do they get eyeballs with? Newsworthy events. And typically things that are newsworthy are things that are going up really fast or things that are going down really fast. It's not the steady climb is not newsworthy. An asset climbing a wall of worry is not something that you're going to see on the headlines of CNBC.
So how do you handle that then? Because that's what you're fighting, right? As an investor, you turn on CNBC or whatever the money show, and like I don't know if it's on purpose, because like you said, they want the eyeballs, but it's just the nature of the beast. By the time they talk about it, the price has moved up. Most people who wanted to buy already bought. So now what's left? Sellers.
Yeah.
That's all it is. There's sellers left. It's I don't know, until somebody finds me something better than charts to analyze price and spot those low risk entry points. It's like I'll stick with that tool for now, you know.
Yeah.
But
so you want to start looking at some charts?
Yeah. Let's look at some charts, commodities.
Yes, sir.
Well, look.
What do you got there? The dollar?
Well, yeah. Well, I'll move on. Let's go to Cameco. Cameco. No drawings. Look, Cameco, that thing was in beast mode. I've covered it pretty much a lot of times on Twitter. This coiling price action. So here it had a great base back in 2000. Is my cursor too big? It feels huge.
No, it's fine. It's
fine?
It's not too big, at least from what I'm seeing.
So back here in December of 2020, Cameco was breaking out. I'll zoom in, guys. This is what I mean, like a base. That is a 2015 all the way. That's a 5-year base. Don't try to catch the bottom. Yes, from the bottom all the way to the breakout, it went up 100% or more. But this candle here, this breakout here, clear breakout. Look, I'll put on the line chart.
Now, when it comes to hitting the buy button, do you typically buy on breakouts or just on bases like this?
No, the breakout. You have to wait for the breakout, because I'll tell you one thing: a base is only a base once it breaks out. Until then, it's a possible base, because this base could have been a halfway flag. I'll show you what could have happened.
No.
It could have been I'm going to hide it here. So let's say we're here. The guy, oh, I'm going to buy, it looks like a base. I think it's going to break out. Well, this thing, I'll zoom out. And that thing could have just been a halfway flag where the next move would have been, let me get my arrows. If it would have broken down to the downside, that could have been just a downtrend. Look at that. That's just a beautiful downtrend.
Yeah.
There's nothing to do here, right? So anybody who's trying to catch the bottom at dollar cost average in, you're doing a coin flip. You don't it's below the cloud. That's just a bearish flag going down. That's all it is right now. We have until it resolves, you don't know what the market's going to do with this thing.
What does the cloud mean? What is the cloud?
Well,
the chart there.
The cloud, the Ichimoku cloud is a Japanese calculation on the price. So essentially it projects future resistance and support. So whatever, let's say, I'll put it back on the hollow candles. All these buyers here, remove drawings. Let's do, well, here. So all these buyers here, if ever the price goes down below, it's going in a downtrend. All these buyers here, eventually there will be resistance later on.
Right.
So it's projected in the future, 52. So until all these people here that bought here, the price would need to go back above it. I think, no, it's this one down here. It's projecting future resistance based on the bag holders over time, and it dissipates. So if you're above the green cloud, that means the people who bought, because you're above them now, they're actually going to be support for you later on. So
and
all this,
and so if you've got a red
here.
cloud over you, that means does that signify resistance?
Yes, exactly. So this one, it's more here because it's in a downtrend. Here, these guys, if the price would have went, let me get my squiggly line. If the price would have went here, it would have been contained by all these bag holders that were here. And now all these guys here creating like a lot of transactions of people creating a high volume defined base. Now it's projected in the future that eventually all these people that bought here, if ever the price comes down here, they're going to want to also support the price. They want to get in, right? So it's a visual way of seeing future resistance and future support. You could just look also at the moving average. So if I remove the cloud, look, it's pretty simple. Look at Cameco in the above an inclining 3-year moving average. What do you mean TA doesn't work? You're above an inclining 3-year moving average. The trend's with you. It's so simple. Here you're below a declining 3-year moving average, and now above an inclining 3-year moving average. Inclining 3-year moving average. See, sometimes the price goes above a 3-year moving average, but it's not staying there long enough to make the moving average incline. But look at this. And this is beautiful here because here you had the crazy move. A lot of people bought here.
Yep.
But then Cameco went sideways for a little while. And what does a correction is two things. It's either the price goes down, lets the moving average catch up, or the price goes sideways and the moving average still catches up via time. And this spot right here was a spot where the moving average was so close that here everybody probably gave up on Cameco or the uranium right here when the moving average here is really close to
the 3-year
price.
Yeah, the
and
price.
Then because you're in an uptrend, those are by the dips, right? Here you sell the rips when you're below. Well, that one, and here you buy the dips once you coil close. And Cameco was just legendary in the 2000s there. So right now, this consolidation pattern, beautiful. It's picture perfect, breaks out to the upside, and now you have a measured move up.
So why do you use a 3-year moving average?
It could have been 4 year, 5 years. This is how chart trading works. Remove indicators. No, I'll do. This is the game people should do. Putting a moving average. Reset chart. Where's my move? Okay, I'll do it again. You tune it. A line, look, a line needs 3 bounces for a line to morph into existence. It could I could have drawn a line here somewhere before it did 3 touches, but it's only a possible line. Here I have 1, 2, 3, 4, a break on the 4th. It's a breakout. So for the moving averages, you could tune it to have it the most touches possible. Look at the 2000s here as I reduce the moving average. I'm at 30 months. I'm going to tighten it up. Oh, 12 months.
Yep.
Here, 12 months. So here I use a 12 months. So depending on how aggressive, because on cryptos, they move so fast in the bull market, a 3-year moving average, it's way too slow.
Yeah, there's too much
You
lag.
probably go to a shorter term moving average. So you see here, 1 touch, bounced. Okay, good. This is meaningful. And after that, it never closed below. Once it closed below, that means it was starting to lose momentum. And then you were approaching a top right here. And then after that, when it broke down below convincingly, even here, you get out, retest from below. So you adapt the moving average to the actual momentum of the price action, right? To fit it, to have a best fit.
So essentially, the longer the moving average, the more confirmatory it is when you actually start seeing it move. Because if it starts moving, that would imply that the most recent candlesticks are so explosive that they're even able to move like a 3-year.
Yes. Look at this shorter term moving average. Here's gold chart. The 1-year moving average. Gold sometimes closes below, but it's maintaining. You could say it's maintaining the 1-year moving average momentum beautifully. Here it broke down that shorter term momentum defined by the 1-year moving average in the GFC 2008 crash. But the 3-year moving average, the longer term uptrend, was able to support the long-term momentum, right? And that's why you could avoid a lot of debates and angry discussions with people on Twitter because somebody says he's bullish, other guy bearish, but often they're just talking past each other because they're both on different time frames. Because somebody in the GFC, I could zoom in here in the GFC, somebody is right to say that it's bearish. It was bearish here. But if you zoom out, so on that smaller time period, it was bearish. But if somebody says, no, look, gold's bullish, and they're also right, right? So here it was bearish on shorter time frame, but still bullish on a longer time frame. So this is another basic premise of chart trading. A pattern's only confirmed when it breaks out, right? But everything is defined by time frame, everything. So each time frame is its own ecosystem, and you do your analysis on that. But there is a rule: is the higher the time frame, the more prevalent, the more strength it has. It's like the bigger waves in the ocean or in the pool will let's say there's a ripple going this way, but there's a bigger wave coming here. The ripple is just going to get destroyed by the energy of the bigger wave, right? And it'll disappear. So that's what happened here. Here you have a tsunami wave as gold was breaking out of a, 10-year, 20-year bear era. Here was breaking out versus SPX. So now you have a tsunami, a capital flows going upwards, and all these shorter ripples, they're just ripples, and you buy the dips until one of these ripples is actually able to break down. Then you get a def cross, and now you see there's a dynamic change, right? Now this arrow is getting bigger, right? So now it's a more meaningful the downtrend, right? It's
and I'm looking at your bottom chart there, the distance from the 36-month or the 3-year moving average. You can clearly see when the black line there gets significantly above the red line, which is your zero distance. That's typically when it corrects back down on the above chart.
Yes.
And then vice versa.
Yes, that's one of our great profit-taking tools. I'll show you my Bitcoin chart there. Sorry, Bitcoin guys, but it's a great example. This is a great place to take profits. So what you do, you could do TA on the distance from moving average. So here are the crazy peaks from the 80s. Here, you see it stopped here, it stopped here, here a little blow off top. So all this was profit-taking area. And right here in the 2020, it got stretched above. So once you're stretched away from the moving average, profit-taking time to, at worst or at best, don't go in when you're super stretched from the moving average. The best entries, you'll see that we're here, this arrow here, maybe here when it was breaking out, and we're gonna have the next one. As soon as the momentum breaks out above that line, And well, I have I have the chart here. And when it breaks out above this final breakout line here, then this is beautiful because the setup is actually pretty beautiful for gold right now. It's a coiling above the 1 year and 3-year moving average, coiled and tight. See here in 2018, coiled and tight. After that, coiled and tight here in 2000, right? Those are the areas where you should start focusing. Okay, where's my entry? When am I getting the breakout confirmed? Not when it's stretched, right? Everybody, my Twitter account was going bonkers when gold was going up here. That's also contrarian signal, right? I was getting like, I don't know how many followers, but look, super stretched. If you're scared of heights, super stretched from the 3-year moving average here. And with TA, I don't know how you could not do this with TA. If you look historically, say, oh my goodness, yes, look, historically, I am stretched, right? Yes, it could go more stretched, but you're like starting to be in nosebleed section a little bit, right? So it's not the lowest entry.
Yeah,
the lowest entry.
The probability of it being more stretched becomes lower and lower the higher you get.
Yes,
So
exactly. Look,
yeah, because here's the thing I want to point out to the audience as well. This isn't a foolproof plan. You're not going to be right 100% of the time, but the idea is if you repeat these practices over and over again, you're going to come out correct more than you're going to come out wrong. You're going to come out ahead. It's an expected value type of thing.
Yes. It's again, look at the pros. Find a repeating pattern where you have an edge, whatever you're like, your dunks, you like the dunks, you like the jab, and just repeat that over and over and over again. I know they're boring. The Lennox Lewis kept jabbing people to death, but eventually that jab won him championships. It did, right? And sometimes it's set up so knockout punch. And if you're lucky, you repeat, and sometimes you'll get lucky and you'll have an overperformer. You will get a Hail Mary in there, but at least the jab's going to protect you from going broke, from putting everything in on a dream to have this guy taking a picture where he's on the beach somewhere and showing his Lambos, right?
Yeah.
It's fine posting all that luxury stuff, but there has to be hard work behind it, or else it's random, right? It's luck, right?
Yeah, I mean, look, you may have been one of the lucky people to buy NVIDIA 5 months ago, but that experiment is not repeatable. You're not going to buy another. The chances are you're not going to find another NVIDIA just by doing what you did. You just got lucky. Well, so what we're looking at here, we're looking to create repeatable practices.
Right. Look at NVIDIA. The last low risk entry was back here in 2000, right here, back in 2015. That was the last low risk entry for NVIDIA. I always look for these 5, 6, 8 year patterns, right? And now you're starting to see this in the uranium sector. This is like Cameco, huge bases. That was the last low risk entry. It had crazy pullbacks, always above the cloud. I could probably fine tune that 3-year moving average to 48, maybe. There you go. It respects very well the 4-year moving average. So that's the low risk entry. And look how you're stretched from the moving average here. It's getting high. It's getting high.
Yeah.
So that's even here. You could say, look, it's hitting here. See here, it got stretched. Doesn't mean the price can't go back up, but it means the momentum's slowing down, right? As the moving average is catching up, the price could still go up, but it's not going up as fast. And this is key. You always want to be going faster and faster. If something's still going in your direction you want, but you're not going as fast, that means the momentum is slowing down. That means your headwinds are starting to overwhelm the tailwinds. And that's a recipe for rug pulls. You want to be here. Look at this. Look at the beauty of NVIDIA here. When it broke out back in 2015, it was just above its 4-year moving average, or no, here's a 3-year. Look, the momentum's expanding. It's able to outpace the 3-year moving average. That's where you have the greatest gains in the shortest amount of time. That's when it happens. That's where you want to be. Now, kind of in nosebleed section, like NVIDIA, you're kind of in no man's land right now. So what do you do here? You're stretched. Was this it? Maybe it's diminishing returns. Maybe I'll never go back as high as these 2 peaks, right? Maybe that's it. Maybe it's going to turn down. It's just the low risk entry is just not there anymore.
But those 2 peaks are like 230% above the average, the moving average. Even right now, even though we've come down from those peaks, you're still 124% above the average.
Here, I'll show you where it could go. I had a $600 target for NVIDIA. When it started moving up, even if I said if ever it goes up here 200% above the moving average, So all you have to do is I'll put in back my 3-year moving average.
What about Bollinger Bands? Do you ever use Bollinger Bands to kind of look at
Yeah,
standard deviation?
I dabbled. Look, the price, a good chart trader will not need any indicators because he'll see the chart pattern. Like let's say a triangle base, and by the length of it, the size of it, he knows what the Bollinger Band is going to look like. You know that when you have a beautiful triangle like this, you know that the moving average is going to be coiled. You know that the Bollinger Bands are going to be coiled, right? So everything's a derivative of the actual price. So that's why I never argue with somebody. Like somebody says, "Oh, I like Bollinger Band there or RSI, whatever fancy, whatever you appeals to you, use it." But at the end of the day, they are all derivatives of the price, right? You cannot, the price, like a good chart trader will just look at this, remove indicators, and that's all he needs. Like the classical TA books there from Edwards McGee and all this stuff, they didn't have any mathematical tools, right? You know, these indicators, they just look at that and they'd see a pull flag here or a bullish expanding wedge. And they knew that when that thing broke out and retested, they'd have a measure move up, you know, that's like, it's just energy explosion, energy contraction, energy explosion, human emotions, right? Fear, greed cycles. It's just that repeats over and over. So yeah, you can have fun with moving averages and all that stuff, but
I guess if you had to choose one indicator to use, what would it be? Like if you had no choice to use one, like you had to discard all the others and just pick your favorite one, what would it be?
Yeah, I think I choose the rate of change. Okay. So rate of change is slightly different than the distance from moving average. Distance from moving average, you can interpret some rate of change. So rate of change tells you, okay, I have to put a longer, let's put some silver chart.
Yeah, you're measuring acceleration at that point.
Here, so here I have the 7-year rate of change. So it tells how much, what's the percentage change if I would have bought 7 years ago, right? For the 7 years. So here, the rate of change is 25. So if I would have bought silver 7 years ago, I'll put here, let me just double click here. I'll put my labels. So 7 years is 84 months. Let's shrink that to 84 bars. 84. Here we are today. So 84. Oh, well, okay. I put on the indicator, but on the price, the price will have moved 84, 84, 84, 84 bars. Here, 84. Here you go. So the price moved. Well, here I have 29%, but if I would have been more precise, it'd be 24%, 84. It tells you that if I would have bought here, that's how much gains I would have had done. So this is important because like the distance from moving average, if the rate of change just goes bonkers, a lot of people made a lot of money. So now all these people who made a lot of money, who bought 7 years ago, they're going to want to start selling, right? They're going to say, okay, man, what's, like you said, like the average holding time, whatever it is, people are going to start, you know, they're going to start taking profits because they hit their targets, etc. When the rate of change is low and starting to move up, I like it. That means some of this downwards momentum from 7 years ago is starting to evaporate. The people who want to sell, as this unwinds, then this becomes flat and has less headwinds. It's able to go up naturally. See this, all these sellers here, all these this blow off top in rate of change for silver. As time went on, the rate of change just went flat. Look here, 7 years ago, 7 years ago, there's like the rate of change is super low. So there's nobody holding that didn't sell. You know, all these people is just like a base creation, right? You saw people buying it that's pretty much at the same price range. When that starts moving upwards, it's telling me, oh boy, something's happening to the price. It's breaking out on the rate of change. And when you have that, that's a great place to be because you want to ride that momentum upwards.
Right.
So silver, you just got to wait. It's not quite doing it yet. So you want to wait for it to show some teeth and start accelerating upwards. Silvers were like one of the most beautiful charts right now, waiting in the shadows there for a breakout. But this thing is just, Jesus. Look, you got to be patient, guys. It hasn't broken out, but it's close. It's close. It's getting.
And essentially, the more meaningful a resistance line or a support line is dependent upon how many times you actually touch it. So you're touching it here 1, 2, 3, 4, 5 times. So
Yes,
that's a fairly strong resistance line.
yes.
So when you do break out of it, doesn't that imply a more violent breakout?
Yes, yes. It's so that's why some people say, "Oh, Patrick, I love your silver charts because I love shorting. I love shorting when we hit your breakout lines." But they're right in the sense I wouldn't do it, but a breakout line is essentially a resistance line. And the more important a breakout line is, the more that implies that it's a more important resistance also. So that's why it's hard to get back above that. But if you do get above a breakout line, that means that resistance becomes support. And now the party starts, because I'll show you here. Look at it here. This was a top here in 2011 to 12. It breaks down. So now this breakdown line, that support becomes resistance. Look where silver years later, 8 years later, look where it halted, exactly at that wall, exactly that zone, right? Can't get above. So here's this line here, the thick dotted line is the embryonic breakout or early breakout line, but the true party, the true party there is up here. And if we break above 28, it's within 6 months, we're above all-time highs, within 6 months, because this is the pull flag in play there. It's the same energy. It's going to be like that there. This is a bullish expanding wedge below an important breakout line, a 13-year, 12-year long-term breakout line. This is the move, guys. So this is the play, but you guys just got to be patient. It's there. It's so easy. All you have to do, guys, I have it. I go in TradingView. Look, bam, plus, that's it. Go to sleep. Go look at another chart. It's like it's like chart porn. I love putting silver charts because it's just beautiful. But this is just going to be bonkers there when that breaks out. It's just going to be bonkers. But we're not quite there yet there. If ever this fails to break out and goes down, recession fears, because silver loves going down. I'll put the recession down.
And silver is more of an industrial metal now than a precious metal like gold. So, and a recession would kind of spell bad things for silver.
Look, I don't know about that industrial thing. It's the gold's the same thing as silver. It'll go down. Remove drawings. It's probably going to go down the same way during recessions. But silver bottoms in the abyss of recession. See here, it bottomed in the abyss, practically in the middle of the recession, which is probably backfilled in time, right? Because by the time they backfilled the recession from, what is that, December 2007, for crying out loud. Nobody was saying there was a recession in 2007, but look, it looks like officially they backfilled it in the abyss at the bottom. It likes bottoming in the abyss here, abyss. Here, abyss. And then after that, it moved up. Here, not quite, a little abyss, but it went down deep. So if silver breaks out, there's probably no recession for the next few months until it does its move, right? Mm-hmm. But if silver cannot break out here and something more crazy like this happens there, Jesus, that'd be crazy, because there's a lot of support right here. Yeah. But if silver does another move like that, this could be the recession that everybody's talking about right here. But we'll only know in hindsight. Like, silver's going to be going down. There's going to be no official recession yet declared. Silver's going to start going up, and then people are going to start, oh, there's a recession, and people are going to start shorting silver, but silver's already going to be moving up. And that's how the news always destroys you, because the metals, they know ahead of time. And look, it's the same as gold.